We are glad to be bringing to you a podcast on an interesting topic, which we hope the viewers will find this very interesting and informative, both. Before we dive into this, we take a few moments to introduce our company, Trustline Holdings, as well as to the two participants in today's session. Trustline Holdings is a 2-decade-old SEBI-registered alternate asset management company based out of Chennai. We are a small cap specialist and a meticulous practitioners of value investing. We are extremely pleased to share that recently our asset under management crossed 1,000 crores. What gives us even more immense satisfaction is that our deep value investment strategy has delivered high alpha returns to our clients over 2 decades and across multiple market cycles. We count many distinguished C levels as our clients, and our client base is nearing 650. About myself, I am Govindarajan. I take care of new business development in Trustline. I have pleasure in introducing other participant, Mr. Arunagiri. Mr. Arunagiri is the founder, CEO, and Chief Investment Officer of Trustline. Arun comes with more than 2 decades of small cap investing experience and has seen many market cycles during this time. Today's podcast, I'm going to be asking a few very pertinent questions, which would be in the minds of the investors. Thank you, Arun, for your time today for the podcast.
Thank you.
The first question I have, Arun, is that our stock market indices like Nifty and Sensex have hit all-time highs, and there is no stopping them. What do you make out of the current markets, and what is your take on this?
Yes, Govind. First, let me thank you for the wonderful introduction. Yes, we have completed 20 years in Trustline. We are celebrating 20th year anniversary this year. It's a great milestone for us. And in terms of 2 decades of value creation and 2 decades of research excellence, I really thank all our investors and our viewers for their support all through these 20 years. I also take this opportunity to wish all our viewers and investors a very, very happy and prosperous year 2024. Coming back to your question, yes, Govind, actually, markets have been on a one-way run for a very long time. Let me briefly explain, why has it been so for almost now multiple months. One standout feature all through this year for our markets has been the role played by domestic institutions and domestic funds. Whenever FIs start on a selling spree on fears of elevated rate hikes, elevated rates, and inflation trajectory, local funds and domestic institutions and domestic funds have always lent support and acted as a counterbalance. That's one point. Second, whenever FIs came back, on slight kind of evidence in terms of easing fears of interest rate hikes, domestic funds gave additional support to give a combo effect to our markets. In a way, these, because of this, I think this market has been on a one-way run for multiple months. If one were to pick out a single most important factor for this one-way run, I think it would probably boil down to this domestic support. And last, this current quarter has been no different. If you go back and look at from the month of September, FI started selling big time from September. In September, they sold close to about $1.85 billion, followed by additional selling of about $3 billion in October. In spite of this, high intense selling in September, October, Indian markets didn't budge. It was very resilient thanks to domestic support. The first sign of reversal in FI sentiment came sometime in mid-November when the inflation, sharply fell in the, inflation numbers from US witnessed a very sharp fall. That, in fact, in turn set off a huge rally in US treasuries, 10-year treasury. So US bond, 10-year bond, the yield fell from near close to 5% to almost near 4% as of November end. Now I think it is hovering close, less than 4%, somewhere around 3.9%. Similarly, dollar index again fell from 106 to sub 103 now. In spite of all these developments, FI selling didn't stop in November. Of course, selling eased. The intensity of selling came down towards the end of the November. But the real turning point for FI's, sentiment and FI's numbers happened sometime when the Fed pivot happened in middle of December. right? Post its policy meeting on December 13th, the Fed chair in its press conference hinted at four key things. One, he said that the interest rates are near peak. Second, he said the discussions on rate cuts have already started. Third, the elevated interest rates are unlikely to last long. And he also added the economic growth in US has started showing signs of slowdown. Post this Fed pivot, markets which are factoring about 3 to 4 rate cuts next year in 2024 started increasing their bets on rate cuts. So basically now markets are discounting close to about 6 or more rate cuts in the next year. This development, positive development, coming on the back of very favorable state assembly election outcome in India, set off the next leg of rally, very, very strong rally in Indian markets. Given this current, given this, very strong settings, market settings, all that the investors who are willing to make an entry can hope for is some level of consolidation or cooling off than any sharp price correction, given the incessant positive news flow. That's what I would say on the markets, Govind. The current market trend, as far as we see from our trust line point of view, that's what I would summarize.
Thank you, Varun, for that elaborate answer. The second question is, investors are in a quandary. Basically, majority of them who have invested, stayed invested, have seen extraordinary returns, and they are unable to decide in taking a call on the overheated positions, especially the overheated positions. And there are other set of investors who are eternally waiting on the sidelines for better opportunities or corrections to happen. So, and there has been an eternal wait. What you would tell them? What would be your advice to such investors who are on the both sides of the fence, for those who are invested and those who are waiting to invest?
Very interesting question, Govind. I think it's true that this it's very challenging times for both sides of the investors. The investors who are sitting on the fence, also investors who are fully invested. In this one-way market, you can broadly, classify two sets of investors. The investors who are fully invested, reaping the benefits of this bull run. On the other side, you have investors, eternally waiting for correction and on this sitting on the fence. This is equally challenging for both. Let me explain why. The investors who are, fully invested want to book profits given the very, very strong surge in some of their portfolio stocks. They want to book profits, but unfortunately, they are also equally worried if the markets were to go up continuously. They will have to, they are, whether they will be selling early. Those kind of, fears and dilemma is bothering the investors who are fully invested. That's the emotional challenge they are going through. On the other flip side, the investors who are sitting on the fence waiting for correction, they are losing patience, driven by the fear of missing out. So, in our view, in these difficult situations, investors have to look at taking a very phased approach, given the unpredictability, the market direction. So, what we would advise is, investors who are fully invested, they should, selectively take a bottom-up stock-specific approach wherever the stock prices are overextended. They should prune and raise their cash level at their portfolio level. Whereas investors who are sitting on the fence, instead of waiting eternally for corrections, which is not coming, should take a very, very phased deployment approach. In any of those asset classes, like it could be mutual funds, it could be PMS, it could be any of those categories, they should try to take a very phased approach. This may seem very contradictory, but this looks like a only practical way to navigate this market, huge bull run in Indian markets. Let me share some example. In our own experience, if you go back and look at July, August, June, these markets were no different. 6 months back, it was on a strong bull run. It has been so for so long. So even in June, July, August, the investors had the same dilemma, whether to look at investing now or wait for correction. Investors who took a call and then started investing in our fund, where we take a very phased deployment approach, very, very cautious phased deployment approach, they have reasons to be very satisfied now looking back. There are two things which we could achieve. Even in this continuous bull market, we could successfully deploy close to about 70-80% of their money without taking too much of a risk. Second, even in terms of portfolio returns, the returns, absolute returns, since the time they have come in, is close to double-digit returns. So they have all the reasons to be happy that they made those investments. So it's not going to be easy for investors to take a call given the very, very one-way kind of a market. So investors, the practical way to navigate these challenges is to take a very, very phased approach. That's what we would suggest for investors who are in a dilemma.
One other question which keeps coming up in client or investor interactions is that people, most of the investors have got memories of 2019, the last general election, how the markets played out prior to that. So they are expecting a similar, expecting at least a similar volatility to set in at some point in time before the general elections. And that could be a time to make a decision in terms of putting the money to work. So what is your take on that in terms of the elections, the effect of elections, impending elections of next year, general elections on the markets?
Yeah, it's a very valid question. On election cycle, predicting the market direction is not so difficult given the market's penchant to make a very predictable pattern in every general election. If you go back and look at the last 20 years, in every general election, the markets have been seen a very favorable movement ahead of the election, except in 2009 when, global financial crisis hit the market. So that was an isolated, kind of an exception. Otherwise, if you go back and look at the last 20 years, in every election, the markets have seen a very favorable momentum. So in our view, post this very favorable state assembly elections, markets have started factoring in political stability and policy continuity. And this will only gain more traction as we near the election when more and more opinion polls and poll surveys start pouring in. So overall, when we look at it is really challenging for investors who are waiting on the fence to get a better entry point for this in this market. And we don't foresee things changing anytime soon. And in the coming weeks and months, it's going to be much more challenging because of the market's tendency to gain more momentum as we approach elections. So given these challenges, I think the investors will have much less choice than to look at some kind of a phased deployment like SIPs through mutual funds, or looking at funds like ours, where we look at a very phased approach, very phased and cautious approach in terms of deployment. So this could be one option for investors to navigate this very, very strong bull market. This is what I would say in conclusion for investors who are in such dilemma.
Thank you, Arun. So the thing is, it is far more difficult to handle the emotions during the bull market than the bear market, I guess, because the decisions are much more easier in the bear market because they get opportunities and it's easier decision. But I think right now, from whatever little I understand from your answers, it's going to be challenging. But I think some insights you have shared at how to navigate this. Thank you, Arun, for your insightful answers. That's about it from our side, and we sincerely hope that this podcast was informative and useful. We will take time off, and we'll bid goodbye to all the viewers. Till next time, we take this opportunity to wish everybody a very happy and prosperous 2024. Thank you very much. Thank you.
Thank you, Govind.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.